Now let's talk a little bit about 2020. Do you expect any ETFs to break out or see outsized performance relative to their benchmarks? Kim, give us your outlook. What's going to break out?
I want to go way down the market cap structure. I want to talk about microcap stocks, IWC. A lot of people are talking about emerging markets. Here's something that's priced the same. 13 times this year's number, 1.6 times book, and it's got a 1.4% yield. If you look at it relative to the S&P 500, it's in the bottom decile for those same factors.
I want to make it clear what a microcap is. We're talking, what, 50 million to 400 million, 500? Is that fair?
That's
What's the difference
fair.
between a microcap and a small cap?
So small cap is going to be the 600 stocks that are below the S&P 500 and the mid cap 400. These microcap stocks, there's 1,400 of them. You got a lot of them. There's a lot of them that probably aren't A students.
Are we talking about stuff that's on the pink sheets too?
No. These
all
aren't
listed
on the pink sheet. These are all listed,
Yep.
listed securities.
And why, just make the argument again, why am I interested in microcaps? Given how volatile they can be, individually, they're extremely volatile, but even as a group.
Correct. So what happens when the global manufacturing PMIs move from below 50 to above, which is the direction they're going right now?
Yeah.
You want to be long size, small cap, micro cap. You want to be long international, and you want to be long value.
You're saying they have similar characteristics. Sometimes they will trade similarly.
Correct.
Okay.
That's exactly right.
Got it. Okay. Todd, you're talking about quality. QUAL we've talked about many times this year. Moderate earnings growth, lower volatility. What's quality mean to anybody?
Well, it is, again, in the eye of the beholder. But what iShares does with the MSCI-based product QUAL, it's the antithesis of what Kim was talking about. These are blue-chip, high-quality companies. Among these are large-cap companies like Apple. You'd find within the portfolio Johnson & Johnson. These are strong companies that, as you mentioned, if the earnings trends tend to be more moderate but positive, the economic trends are positive, this is a good way of going, and it's beating the S&P 500 this year and is likely to do well again in 2020.
So you get low vol companies like, Pepsi, and then higher volatility companies like Facebook in there. So it tends to tilt towards lower volatility, it seems to me, but good earnings growth.
Correct.
Define quality. That's the point.
So these are going to be higher growth companies than you'd find within a traditional lower volatility portfolio. These are companies that are standing out, that still look good to us at CFRA Research.
Okay. How about what might surprise us in the ETF market in 2020? Todd, anything surprising coming down the road?
Well, so we have actively managed ETFs that are going to be coming in 2020 for the new regulatory environment that's happened, non-transparent ETFs. There are some not actively managed ETFs that are doing well. Kim happens to offer one of them separately, but we think we're going to see mutual funds actually convert into an ETF to use the benefits of this structure, the tax efficiency behind it. You've got T. Rowe Price, you've got Natixis that are going to do it the traditional way. We think others are going to do it in an untraditional way.
The untraditional way being what, Kim? And what is going to happen here that's different? I mean, look, I've said many times, I'm fine with non-transparent ETFs, but just because you're a loser as a stock picker in an active mutual fund, it doesn't mean you're going to be a winner in a different wrapper, called an ETF wrapper, if you're an active stock picker. I guess you have to explain this to the viewers. Why is this suddenly going to transform?
Well, I think you're spot on there, Bob. I think performance still matters and cost still matters. So if you try to wrap it around and it's high cost and bad performance, I don't care if it's a non-transparent new whiz-bang theory with the ETF wrapper, it will not sell.
Yeah.
But if some of the strategies that are coming out from T. Rowe Price, these have strong track records, they have relatively low cost structures, they will gravitate.
No
there
problem
are
with
good
doing
active
that.
managers, not just bad ones.
What I think that this is a great opportunity to find really good active managers at lower prices, which is exactly Jack Bogle's ultimate revelation 40 years ago, that it's not that there isn't any good active managers, it's just that they charge too much and it destroys the alpha that they generate. Maybe this will get closer to Jack's dream.
And this marketplace is still very nascent. Like Todd mentioned, we have a product that's been out there for 2 years and has 550 million. It's the third largest at 550 million. There's a lot of runway for people to get into it.
Okay.